If you qualify for both a USDA and a conventional loan, you might be thinking, why not just go with the zero down option? But before you do, let's compare both side by side. One may cost you more in the long run or limit your options in ways you may not realize up front. So, who actually qualifies for both the USDA and a conventional loan? Typically, it's someone with pretty good credit, usually a FICO score of 680 or higher. You'd need a stable income that's within the USDA's income limits, which means your income isn't too high. You also have to be buying in a USDA eligible area, which is usually rural or suburban. And ideally, you've got some savings available for a down payment and closing costs. If this is you, you have a choice most buyers don't, and it's worth taking a closer look. A lot of people who get conventional pre approval might feel pressured to go with the USDA loan just because it's zero down, even if they have money saved. USDA can sound like a no brainer. Why wouldn't you take the zero down payment option? But sometimes what feels easier now can cost you more in the long run. For example, let's say you're a first time homebuyer with a 710 credit score, about $15,000 in savings, and you're looking at homes in a USDA eligible suburb. You technically qualify for both loans. You could use USDA and keep your savings intact, but that means paying mortgage insurance for the life of the loan and having less flexibility if you want to refinance. On the flip side, you could put 5% down on a conventional loan, build equity faster, and avoid PMI sooner. There's no right or wrong answer here. It just depends on your comfort level, your timeline, and how long you plan to stay in the home. Let's start by comparing the upfront costs. With USDA, there's no down payment required. Typical closing costs can range from 2 to 6% of the purchase price. Sometimes those can be rolled into the loan if the home appraises for more than the purchase price, or they can be covered by the seller. For conventional loans, you usually have to put down at least 3 to 5%. Closing costs for conventional loan are the same, 2 to 6%. You can also ask the seller to cover some or all of the costs, and in some cases, the lender may allow you to roll them into the loan. But just know when you do that, you'll usually get a slightly higher interest rate in exchange. You can use down payment assistance programs to also minimize your upfront costs. So with USDA, you may be able to buy a home with no savings, but if you do have money saved or you can qualify for down payment assistance, conventional gives you more equity right away and the ability to avoid mortgage insurance sooner. And that can make a big difference in your long term costs. Just to clarify, home equity is the amount of the home's value that you actually own. It's the difference between the current market value of the home and your outstanding mortgage balance. You gain equity as you make payments and as the value of your home goes up. I've got free resources at workwithdang.com. You'll find a quick start homebuyer guide, access to my free home buying course, and I can help connect you with a real estate agent in your area. There's more information on my website. I make videos like this every week. Please subscribe if you haven't already. Let's break down the monthly cost. Starting with interest rates, USDA rates are often lower. If you're getting the USDA direct loan, it can be about 2% lower than what you find on the open market, and in some cases, even more. USDA direct rates can even be subsidized down to 1%. Even with the USDA guaranteed loan, the interest rate is usually a little lower than what you'd get on a conventional loan. Then there's mortgage insurance. For USDA loans, there's an annual fee of 0.35% for the life of the loan. With conventional loans, PMI can be removed once you reach 20% equity or waived entirely if you put 20% down up front. Mortgage insurance is a fee that protects the lender if you default on the loan. Basically, if you stop making payments, the lender doesn't lose as much money because they've got insurance paid for by you. So let's do a quick example. Let's say you're buying a $300,000 home. With a USDA loan, your monthly payment could be about $1,835 with zero down. With a conventional loan, assuming you put 3% down, your monthly payment could be around $1,920. These figures don't include property taxes or homeowners insurance, which will increase the final payment, but this gives you a ballpark. The USDA loan usually has a cheaper monthly cost up front, but remember, PMI drops off on the conventional loan once you hit that 20% equity mark. So while USDA might be cheaper at first, conventional could cost you less over the life of the loan, especially if you're putting more than 3% down. Now let's talk about restrictions, which is where some big differences show up. With USDA, like I mentioned earlier, you have to buy in an eligible rural or suburban area. I've included a link in the description to the USDA eligibility map so you can check your location. With a conventional loan, you can live pretty much anywhere, including closer to the city. So if you're looking to buy in a non eligible area, conventional might be your only choice. There are also differences in property condition requirements. USDA loans come with a stricter appraisal and condition rules. Homes have to meet certain safety and livability standards. So, if a property has peeling paint, a missing handrail, or anything else that doesn't meet their guidelines, the loan could get denied unless you were to get the item fixed. FHA and VA loans have similar restrictions. Conventional loans, on the other hand, are more flexible, especially if you're buying an older home or a fixer upper. Another thing to consider is mortgage insurance flexibility. With a conventional loan, it's often easier to refinance and remove PMI. With USDA, that 0.35% annual fee stays on for the life of the loan unless you refinance out of the program entirely. You also build equity faster with conventional, especially if you're putting money down up front. That's another reason conventional loans might make more sense if you think you'll want to refinance in a few years. You can more easily switch into a lower rate or shorter term. With USDA, it's a bit more complicated, especially if home values or rates change. So, if refinancing is something you're considering, conventional gives you more flexibility. So, which one actually gets you more house? With USDA, the debt to income ratio or DTI limit is typically capped at 41%, which can limit how much you qualify for. The conventional loan usually allows for a higher DTI around 45%, and sometimes even up to 50% depending on your credit and other financial details. So, technically, conventional gives you more room to stretch your budget, but keep in mind stretching your DTI isn't always wise, especially at today's interest rates. A higher approval amount could come with more risk if the monthly payment ends up being more than you're comfortable with. So here's where I land. USDA is the better choice when you don't have money for a down payment or you'd rather not use your savings. You're buying in a USDA zone, you want the lowest monthly payment right now, and you plan to stay in the home long term. Conventional is better if you have a decent amount of savings, you want to live outside USDA eligible areas, you don't want mortgage insurance for the life of the loan, you want more flexibility in choosing a home, or you're planning to refinance sooner than later. If you're still not sure which loan makes the most sense for you, check out my video, How to Choose the Right Loan Type. I break down all the major options USDA, FHA, VA, and conventional and help you figure out what actually fits your situation. Thanks for watching, and if you got any value from this video, go ahead and like, subscribe, and comment.